Hi traders, let's talk about something we've all used in trading. Fibonacci retracement. You know the drill. Connect the highs and lows and voila, you've got key price levels to watch. But here's the thing. How many times have you seen the price ignore those golden ratios like 50% or 61.8%? Sometimes it slices right through them. Other times it barely reacts at 38.2% before marching along its trend. Sound familiar? It can be frustrating and leave you wondering, am I doing something wrong? Or is there more to Fibonacci than meets the eye? Here's the real question. When is the right time to draw Fibonacci, and how can we pinpoint the best levels for it? This is a challenge for everyone, from newbies to seasoned pros. Because let's face it, sometimes Fibonacci feels more like a guessing game than a strategy. That's why I'm excited to introduce Fibonacci Mystery, an indicator that offers a smarter way to identify Fibonacci retracement. But before we dive into how Fibonacci Mystery works, let's first see how the indicator performs across different bar types. Here are signals on 1-minute bar type. Here is signals on King Renko bar type. Now let's break down how the indicator actually operates. To form a bullish Fibonacci retracement zone, the indicator first locates the lowest swing low from the previous downtrend. Next, it identifies the first swing high in the current uptrend and marks it as the 0% point on the Fibonacci scale. From there, a bullish Fibonacci retracement zone is created. We'll get into more detail soon on why this zone is only drawn within a specific range. The return signal will be triggered when the price enters the predefined Fibonacci zone. So here's the big question. Why did we choose this specific mechanism to identify bullish Fibonacci retracement zone? The lowest point in a downtrend represents significant buying pressure, strong enough to push the price upward and cause a trend reversal. The first peak in an uptrend indicates a weakening of recent buying pressure, suggesting that a price correction is likely. Fibonacci retracement helps you identify how far the price might correct before resuming the main trend. These are the golden ratio zones that traders often look to for trading signals. On the other hand, let's discuss the bearish Fibonacci retracement zone. Identify the highest swing high in the previous uptrend. This will be the 100% level in the Fibonacci retracement. Next, to determine the 0% level in the Fibonacci retracement, the indicator will identify the first swing low in the current downtrend. From there, the bearish Fibonacci retracement zone will be established. When the price enters this zone and reacts, the indicator will look for and suggest a sell signal on the chart. The highest peak in an uptrend represents a strong increase in selling pressure, pushing the price down and causing a trend reversal. Conversely, the first trough in a downtrend reflects a weakening of the selling pressure, indicating that a price correction may occur. At this point, Fibonacci retracement will help you determine how far the price will correct before resuming the main trend. Next, we will dive into the interesting part of the indicator, which is how to classify signals based on the Fibonacci retracement zones that have been formed. The indicator allows you to classify and trade two different types of signals, pullback and reversal. For pullback signals, focus on the Fibonacci zones drawn with solid lines. These are the areas used to look for pullback signals before the price resumes the main trend. Solid line zones indicate that the price has not yet exceeded the price range at the trend transition point, suggesting that these areas still hold value for exploiting pullback trades. When the price surpasses the first swing level, Fibonacci zones will switch to dashed lines, guiding you to look for reversal signals instead of pullback signals. At this point, the Fibonacci zone will no longer hold value for finding pullback signals, but will be useful for identifying reversal signals. At this point, the Fibonacci retracement zones drawn on the chart with dashed lines will be used to identify reversal signals when the price returns and reacts at those levels. The reason why the Fibonacci zones with dashed lines are used to look for reversal signals is that, as you know, the bearish Fibonacci retracement zone is formed at the highest peak in an uptrend. This peak represents a point where strong selling pressure occurs, acting as a natural resistance level in the market. When the price returns to this previous peak level, it often reacts and leads to a trend reversal. Conversely, as you know, the bullish Fibonacci retracement zone is formed at the lowest point in a downtrend. This bottom represents a point where strong buying pressure occurs, acting as a natural support level in the market. When the price returns to this previous bottom level, there is often a market reaction, leading to a potential trend reversal. The biggest benefit of this is that it allows you to trade both when the market is trending and when the market is ranging sideways. For pullback signals within solid line Fibonacci zones, this provides an opportunity to enter a good position right at the start of a trend. As a result, you can achieve a high reward-risk ratio, especially when the market is trending strongly. Reversal signals within dashed line Fibonacci zones. These signals help you trade when the market enters a sideways phase. Observe the chart for a specific example when the market is ranging. You can see that the market lacks a clear trend and continuously touches the bullish zone before bouncing back, then touches the bearish zone and drops, and then touches the bullish zone again. This pattern repeats, creating a range-bound trading condition. Next, we will discuss how to set up the indicator and choose entry points that align with your strategy and trading style. First, focus on the Fibonacci zones. You can see the signals being proposed at levels ranging from 50% to 100%. However, if you only want to look for signals within the golden ratio zone of Fibonacci, from 38.2% to 61.8%, you can adjust these levels in the parameters of the indicator. Note that the indicator allows you to adjust 4 Fibonacci levels. However, if you're only looking for signals between 38.2% and 61.8%, you should adjust the 3 Fibonacci levels to 38.2%, 50%, and 61.8%, with the final Fibonacci level also set to 61.8%. At this point, you can see that the indicator has updated the zone for searching trading signals. Next, you'll choose signals that align with different stop and target levels. Pay attention to the zone formed between 38.2% and 50%, known as the mid-retracement zone. Typically, when the price touches this zone, it will bounce back, but not too strongly. Therefore, you should set a moderate target, not too large, to achieve better profits. However, if the price enters the zone between 50% and 61.8%, this is the deep retracement zone. When the price retraces and touches this zone, it typically bounces back strongly, allowing you to set a larger target. A useful tip when using the indicator is to take advantage of the trend plot line to adjust your stop. For example, when you enter a buy position, move your stop when the trend plot line turns green. Conversely, when you enter a sell position, move your stop according to the pink trend plot line. And that concludes today's video. In this video, we explained the entire mechanism of how the indicator works and shared why we chose this approach, as well as how to use the indicator effectively. I hope you find this guide useful for your trading. If you have any questions, don't hesitate to contact the ninZa.co team. We are always ready to assist you. If you enjoyed the video, please hit like, subscribe to the channel, and click the bell icon to stay updated on our latest videos. Thanks so much, and I wish you all successful trades. I'm looking forward to seeing you in the next videos.